Okay, we're going to go ahead and get started. Good afternoon. My name is Dave King. I'm with HR and I'm here to represent Who's Well and welcome all of you to today's 3 o'clock webinar surrounding mortgages. And with us today, we have Matt Sweetanos from the University of Virginia Credit Union. And Matt will be here today to go through his PowerPoint. Just a couple of housekeeping items. If you have questions, great. Please use the Q&A feature in Zoom. If you go ahead and submit those at any point, you can do that anonymously or you can leave your name on. We'll probably hold the Q&A until the end. There'll be plenty of time. And we will, with that, I'm going to turn this over to Matt. So Matt, welcome. And you can go ahead and share your screen and get started.
Thank you, David. I appreciate it. And thank you, everyone. It's a pleasure to be here this afternoon. And hopefully you can now see the first slide up there. Actually, now you can see the first slide up there. So anyway, I appreciate it. Thank you very much for allowing me to be here. I'm with the University of Virginia Community Credit Union. And we do, just so you understand a little bit about who we are, we do a ton of financial education as well as have great financial services. And I am the Director of Mortgage Services. And I'm going to go through this presentation about qualifying for a mortgage. Now, it is focused mostly on buying a house. So there are things in here that are certainly common to doing a refinance. And if you paid attention to the just sort of to the news, you know, there's a lot of refinancing going on because the rates are just so good. That also really helps with home buyers because it allows you to qualify for a little bit more house and get a nice 30-year fixed rate and lock it in at a very, really good rates right now. So with that, I'm just going to move on to a little note from my compliance department. That the seminar is intended to provide general information only and is not to be construed as specific legal, insurance, or tax advice. So you can read the rest of the disclaimer, but with the legal stuff out of the way, let's move on to some objectives. So number one, if you're thinking about buying, this is going to be good information for you. You do want to kind of take the step of really getting things in order. And if you're attending a mortgage seminar, you're doing the right thing. A lot of folks just start with Zillow and Realtor.com and start looking at houses. And that is a great first step, but it is a horrible thing to get married to a price point that you're really not prepared to be in yet. So, and if you've seen, you know, the market at all, you know that home prices have not gone down. They continue to sort of go up as supply has shrunk. So we'll talk a little bit about getting your finances in order and then the mortgage process. So if you've ever done any kind of loan, if you've done an auto loan or student loan or a personal loan or just anything, you're aware at least a little bit about the steps. There's going to be an application. You're going to provide some personal information. Somebody is going to look at it, an underwriter, and make a credit decision, and then you're going to get the loan. And typically in a, you know, like an auto loan, that happens pretty rapidly, usually within a day, maybe 2 days, depending on how much information is needed. Mortgages are a little more invasive than that. So they're a little bit closer to an IRS tax audit than they are to that other process. So we'll go through some of the steps. There are a few moving parts. And the last part, which is the payoff, would be closing on your home. And so we'll talk about all the steps in between there. So first off, you're thinking about buying, are you ready? Stable job in this environment with COVID is probably more important than ever. And, you know, if you happen to work for UVA, that's a real positive. We do a lot of loans for people who are employees of the health system and of the university. And, you know, that's a good stable position. Is your income steady? Again, in most cases, you know, depending on what your background is, that is going to be hopefully a yes. But again, with COVID, sometimes that has been more in question, I think, now than at any other time. And so just so you understand, that is an area that an underwriter is really going to look at. They're going to take a real hard look at income because everybody is being careful there. And then are you planning to stay in the area? You know, if you're in a position or have a job where you think you might be out of here in the next year or 2 years, buying a house is probably not the best choice. Typically, you'd want to be in this area for the next 5 to 10 years. Not to say that any house that you buy couldn't eventually become maybe an investment property if if you leave and it no longer is your primary residence. It is not a problem typically to turn that into some kind of an investment property if that's in your future. But in general, planning on at least keeping the house for the next 5 to 10 years really makes the most sense when you look at the investment that you're making. And then life events to consider. I think one of the best pieces of advice that I ever got when my wife and I were looking at buying our first house, we lived in Tampa at the time, and we were looking at what I would call starter homes. They were very small, and in the neighborhood we were looking in, about every third house was for sale. And I remember talking to a friend of mine in the mortgage business saying, "Hey, I found this great neighborhood. There's a ton of homes for sale here." And he said, you might want to consider that as a bad thing, not a good thing. The fact that everyone's trying to leave that neighborhood. And, his advice was maybe find a more modest house in a neighborhood that is a really desirable neighborhood. And that would be a really good choice. So, anyway, so you want to consider your life events and what your needs are going to be, not necessarily at the moment, but where they might need to be in the future. So, buying enough house and not buying too much are all things that you want to consider. So let's talk about the 4 C's, and that is going to be capacity, collateral, capital, and character. These are going to be just some of the things that are going to be considered, and we'll talk a little bit more in detail. But it is important to note whether or not you have the capacity for the house that you're purchasing. Will the collateral itself support the loan? Because mortgage loans obviously are tied to, they're tied to the house. And do you have the income and the down payment for the house? And then character really refers to credit, and we'll talk a little bit more in detail on credit. One of the things that you can do, and I really encourage this for everybody, is to go to annualcreditreport.com. It is a free service that's offered for everybody to get their credit report. It is, you're not going to get a credit score, you're going to get a credit report. You should get it once a year anyway, and it really does help to make sure that there's not been any kind of identity theft, but more importantly, it's errors. Has something been reported late when you were not late? That's a really important thing because it's going to have a negative impact on your credit. You also want to look at, do you have the right mix of credit, which we'll talk about in a little more detail. But, do you have trade lines that are very new? Do you have a mixture of installment and revolving debt? All that's going to be important as you consider applying for a mortgage loan. So let's talk about FICO scores. So FICO is kind of like, it's a trademark term, sort of like Kleenex. So we use it generically to talk about credit scores, but there are other credit models. And if you're a user of something like Credit Karma or Experian Boost, or there's others out there, a lot of those companies will use a different model than a FICO score. And to be fair, there's about 650 different FICO models. So if you, are getting a FICO score, it's not necessarily the same FICO score that I'm going to pull when I do a credit pull. So the mortgage world has its own set of models that are used consistently between mortgage lenders, but they are different than if you, again, got an auto loan or any kind of consumer loan. So the scores may be a little bit different, and they could be higher or lower because they are looking at different percentages. So the percentages you see here are really typical for a mortgage. So when you look at how things are weighted and what's important in your credit history, the amount that you owe is going to be 30% of that FICO score. Payment history is going to be 35%. So those are the two big ones. The one that everybody worries about is a hard hit on their credit. So of course, if you get a mortgage or any other kind of credit, you're likely to have a hard hit on your credit, and it may hit one bureau or it may hit all three bureaus. If you get a mortgage and you're getting pre-qualified, it's going to hit all three bureaus. But that's only a piece of that 10%, which is the establishing new credit. So it's not really the biggest part. That's not to say it might not have an impact. The place where I have seen new credit cause problems is when somebody is shopping for lots of different types of credit. So for instance, if you're shopping for something that is rate competitive, be it an auto loan or a mortgage, you can have multiple credit pulls within a window of time. Usually that window is about 2 weeks. And you can have multiple pulls on your credit report, and it's only looked at as one hit because the bureaus recognize that you need the ability to rate shop, and the only way you can do that is to have your credit pulled probably at multiple places. So so that is not going to be any more of a problem than what the first credit pull was. Now, I will say, if you are newer to credit, if you have what we would consider a shallow credit report, any sort of negative, meaning new credit or just anything, even closing credit, can cause a problem because it limits your access to credit. So any of those things can have sort of an outsized impact on your credit score. Really, the best advice I can give you is if you're looking at getting a mortgage, you probably that's not the time to start working on improving your credit score. You want to do that in advance. And it can take time to really build a credit score. If you've had any kind of negative derogatory effect of any kind on your credit, it can take 12 months to 2 years to rebuild that to a good level. And credit score is really important when it comes to the mortgage rate that you're going to be getting. So FICO score, length of credit history, credit mix, all of that is incredibly important. So if you're working towards building and improving your credit, it should stand to reason that paying your bills on time would be important. Now, when I was first starting out and before I met my wife, my way of paying the bills was to wait until the one in the red envelope came because I didn't care. I didn't really have a lot going on then. And I wasn't really building good credit. And fortunately, my wife straightened me out. So, pay your bills on time. Do limit the credit applications, but do make sure that you have enough credit because your access to credit makes an impact. And if you have a credit card that might be a $3,000 limit, if you can increase that limit, that usually doesn't have a negative impact on your credit. And if you can bring it up to 5 or 10,000, you don't have to use 5 or 10,000. That's the important part here. You want to still limit the amount of credit that you're using. Typically on revolving debt, you want to keep it to 10, 15, no more than 30%. Definitely below 50%. So as credit gets more fully utilized, it does become a negative. And that's true whether you have a $3,000 credit card or a $10,000 credit card. There is a place where they are really just looking at those percentages, and that will have a potential negative impact on your credit. So as you can see here, keep your balances low. The other reason for keeping your balances low is that one of the pieces we're going to talk about is the debt ratio. And we look at minimum monthly payment. So obviously that minimum monthly payment on a revolving debt is going to be much better if you have a lower balance. So if possible, probably a good idea to try to keep that down. So the other part I had mentioned about not closing accounts before applying. So your access to credit, even if you have a credit card, maybe it's a store card like a Lowe's card or a Belk card, and you're thinking, I don't really need this. I should just close it out. That's probably not the best time to do that because it then shrinks your access to credit, which factors into your FICO score. So really, that's probably not the best time to do that. When they talk about an anchor card, let's just put it more along the lines of it's much better to have one credit card with a balance on it than to switch between cards. So if you're trying to switch to get to the lowest rate and you're constantly moving the same balance from place to place, that's not going to be a positive. So the folks who I see who have really excellent credit, 800 and higher credit score, which for a FICO model, 850 is the maximum for most of the FICO models, sometimes 830 depending on the credit bureau. And each of the 3 credit bureaus, while they all use a sort of FICO score, they're using different models. So that weighting that was on the previous slide, that is a little bit different for each of the 3 bureaus. So you're going to get 3 different scores. And one of the things, though, that is really consistent is the longer you've had credit, the better it is. So if you had one card for 10 years, that's a really good thing. And that even just having the one trade line, I've seen people with very excellent credit scores because they've had it for a long time and they've established a really good payment history. So all that is really important. And keeping a good mix of credit. So I would never encourage someone to go out and get credit they don't need, but a mixture of installment debt, like a car loan or a student loan or anything that's going to be paid off within a certain time period, plus revolving debt. Having it all revolving debt, credit cards and lines of credit is not necessarily going to be the best thing for your credit score. So keeping a good mix of credit, having one anchor card, and again, not closing accounts before you apply. Those are all going to be things that will help you when it comes to credit score, which is going to be very important for mortgage rate. The crunch the numbers. So, you do want to review your current spending budget. So one of the things that you're going to do is you're going to go in and you're going to want to get pre-qualified for a mortgage. How much can I buy? And it's a little bit of a chicken and an egg thing. So one of the things you really need to know, though, is how much can you really afford to spend for your house payment? If you currently pay rent, how comfortable are you at that level? And then if you have to increase that, how comfortable would you be? For instance, if you're paying $1,500 a month for an apartment, could you go to 1,800, and would that still fit within your budget? You'd still be comfortable. And if that's the case, are you putting away $300 a month right now? So are you able to save that differential and just stick it in a savings account every month right now? If that's not something you're comfortable with, then you really want to consider carefully what the difference between what I might be able to qualify you for in a house payment and what you're comfortable actually paying in a house payment. So you do want to prepare a new budget, and if you don't like the budget process, just make it bullet points. What are the main things that you spend money on, and then if you can sort of block out your income and make sure that there's more income than there is month, then that's going to work out great when you go to try to get a mortgage. In that house payment, so when we are counting, the mortgage is counting the house expense, we're going to look at more than just the principal and interest payment. So we're definitely looking at principal and interest, and the lower that interest rate is, the better that payment's going to be. But there's the other pieces, which are going to include insurance. Now, when you start talking about insurance with a mortgage, there are probably 3 different types. There's title insurance, there's homeowners or hazard insurance, and sometimes we use these interchangeably. And then there's PMI, which is private mortgage insurance. So let's just talk a little bit about each one of these, because they're an important piece for qualification. So PMI gets a bad rap. People don't ever pay private mortgage insurance. That's a waste of money. It's really not a waste of money if you don't want to put down 20%. And let's face facts, if you're buying your first home, you probably don't have 20% to put down. That's an awful lot when you consider the starting home prices in Charlottesville are probably between $300,000 and $350,000. That's a lot of cash to have as a down payment if you're trying to put down 20%. Great goal, and if you have the means of doing so, I definitely encourage it. But private mortgage insurance is not really a bad thing. It allows you to keep your money. And let's put it in this perspective. Let's say you could afford a 10% down payment, but you also know that maybe that new house that you're going to buy isn't perfect. And maybe there's some things you want to do, like recarpet it or paint it, or anything that costs money. And when you have a house, pretty much everything costs money. So having some extra cash, not a bad idea. And I always look at private mortgage insurance as sort of the cost of keeping your own money in your account. So what I mean by that is, if you were to put down 5% versus 10%, you would pay a higher private mortgage insurance premium. And just to sort of outline for anyone who's not familiar with it, if you put down less than 20%, statistically, you're at a higher risk of default. So to mitigate that, what the mortgage companies do is they say, we need you to have this monthly insurance premium that you're going to pay to a company who's going to indemnify us in case you default. So a mortgage insurance company is a large insurance company that is going to, in addition to the lender, they are also going to underwrite the loan. They're going to look at it and they're going to say, yeah, based on this profile, we're comfortable with that. We're going to charge you X as far as a premium goes. And that monthly premium will be paid for a period of time until you develop enough equity that you can, then not need that private mortgage insurance anymore. And there's other types of insurance, including government insurance, that comes with some different loan products that I'll touch on as well. But private mortgage insurance, while you're paying that monthly premium, you're also not taking the money out of your account. You have to sort of do the math on that and see if it makes sense. Again, access to your own money is sort of what you get with private mortgage insurance, or you just may be limited in the amount of down payment that you can afford. You can have a conventional mortgage with as little as a 3% down payment if you are a first-time buyer and have adequate credit. Then you can go as little as 3%. With a government-backed loan, an FHA loan, which is Federal Housing Administration, you can have a 3.5% down payment. And instead of private mortgage insurance, there'll be a government insurance program that is backing that. And that can be a good option in some cases. So PMI, private mortgage insurance, or some other type of insurance is going to be a piece of your monthly payment. Homeowners insurance is the other one. So we call it hazard because it's for a hazard. Something falls on your house, it catches on fire. That's what this insurance covers. So everyone's pretty familiar with that one, but that has to be counted. And that premium is going to be something you'll want to shop for. And we'll talk a little bit more about insurance, but I would always tell people when they're buying a house and they're writing a contract and there's so much going on, don't forget the insurance because it takes a little longer than you think. So we'll touch on that a little bit more. Real estate taxes. So that's going to be a big piece of your monthly payment. And where you live is going to determine how much those taxes are. You may pay a little more in the city of Charlottesville. You may pay a little more if you're in Fluvanna County. You may pay less if you're in Louisa. Pretty much you just need to know what those tax rates are because it's going to make a difference when you're qualifying, especially if you're buying at the top end of where you qualify for a home. Knowing how much those taxes are going to be will be important. Homeowners Association dues does not apply to every house, but if you're buying a house where it does apply, knowing how much those are going to be, what you're getting for that, what your rules are. If you're living in a community that has a homeowners association, all going to be important, but we're going to count that. It's not actually going to be part of your mortgage payment, whereas PMI or other insurance, hazard insurance, and real estate taxes, they will be collected as part of your monthly payment. Homeowners Association dues are typically collected afterwards or separately. And then occasionally there will be something called subordinate financing. So, back in the day, not so popular anymore, there used to be loans where you would combine a first mortgage of say 80% and then a second mortgage that would represent another 10%. And then you would put 10% down yourself. So it'd be an 80-10-10. Those were reasonably good options. As tax laws change and what you can write off for the interest, those have kind of come and gone, and private mortgage insurance has come down in price. So I really don't see those much anymore, and there has been some reluctance, I think, for institutions to offer those. The second position loans are not always the best. Typically, they're at a higher interest rate. Sometimes at a much shorter term. So that's not that popular product, but it's a possibility. So as you're saving for your down payment, so that's the down payment is your skin in the game. It's your investment in that house. The larger that investment is, and again, this is statistically speaking, this is not for any individual, but the larger that is, the less likely a person is to walk away from that investment. So if you have a 20, 25, 30% down payment in a house, you're going to make that mortgage payment because you have so much invested in it. But even a 3% down payment, though, nobody wants to walk away from that either. So the percent of your mortgage is going to be related to your down payment. If you put in 3, we're going to lend you 97%. If you put in 10%, we're going to lend you 90%. And it does vary by program. So we do a lot of conventional loans. We do some government loans. And I should point out the down payment can be as low as 0. There are some great programs that offer 0 down payments. One of which is going to be the USDA Rural Development Loan. Again, we'll touch on that. And the Veterans Administration Loan. That's another one that is quite good. So house hunting. We'll just go through this kind of quickly. Don't prejudge homes. And I'm just going to put my plug in for real estate agents because a real estate agent is going to be one of your best guides. You can do a lot of research online, but nobody knows the market like a local real estate agent does. They know when houses have been listed for a long time. They may have some knowledge about why a house isn't selling if it isn't selling. You need to, so I would highly recommend a real estate agent. as you're house hunting. You will need to have your financial parameters. That's something that we're going to set up. And obviously you want to look at all homes in your range, but the question is, are you okay with a townhouse maybe, or a condominium, or does it have to be a single family residence? Those are all considerations that have to be worked through. Looking at homes is really the fun part. It's become a little more challenging, but I will say that everybody is adjusting, and there are still the opportunity to go and take a live tour of a home with a real estate agent. There are also some great virtual tools available where you can really get a great look. I highly encourage, though, physically visiting a house, because it's not just what's in the house, it's what's around the house. Neighborhoods vary, and you sort of want to see the whole package because that's what you're buying. And knowing the market, so it may not come as a big surprise that it's quite a bit of seller's market, but I will caveat that with saying that in Charlottesville, that's dependent on the price point. So if you are at a more of an entry-level price point, which in our market is really up to maybe $350,000, it's very competitive right now. And it's competitive because there's not a lot of inventory. New home builders are typically, at least, again, how far you are from the center of Charlottesville is going to determine to some extent what kind of price and what kind of features you're going to get. You may get a similar price with fewer features if you're very close to the university or to the health system, and you may get a lot more if you're further away and you are willing to drive further. But overall, that price point is pretty popular, and because it's popular and because there's not a lot of houses on the market, that it tends to be more of a seller's market. So we see people putting in full price offers and sometimes exceeding the full price offer, which can lead to its own problems. But that's sort of where we're at right now. And the caveat to that is if your price point is higher. So first-time home buyers may be in that less than $350,000 range, but a second home buyer or a third home buyer who's moving up may be more like $500,000 to $700,000, and that's more of a buyer's market in Charlottesville. There's a lot more inventory available, a lot of new homes that are available that fit into that market, and so there is probably going to be the ability to do more negotiation, depending on what your personal requirements are. Now, once you get to writing a contract, you are going to have some contingencies. So mortgage approval in a typical Virginia area real estate contract, the VAR contract, there is a built-in contingency for financing. So if you are not able to qualify for your financing, then you're not required to buy the house, which is probably a good thing. There's also a home inspection. The home inspection is one of the most important contingencies because as you walk through a house, you look through it, everything looks fine to you. And a lot of times it's easy to get excited about the house and the features. A home inspector is someone who works for you. So I don't hire them. I don't ever like to see a home inspection report because the home inspector typically will find lots of stuff, because any house, it can be a brand spanking new house. And don't think if you're buying a brand new house that you shouldn't get a home inspection. It actually makes really good sense because just because it's new doesn't mean that everything's perfect. And in fact, I would almost guarantee that there is not going to be a perfect home. And a home inspection will cost somewhere between $350 and $500, depending on the house and complexity and so forth. But it's a good investment. They do find everything. They crawl into every crawl space, crawl up in the attic, and they'll give you a full report. Typically, it can be a 20 to 40 page full color report, and it'll vary with things that are actually really serious to things that are pretty minor. But the important piece of a home inspection is that it does become a negotiation point for you. And it is your way of getting out of a contract. If you sign a contract and you have earnest money at stake, and you decide that there are just some problems here that were unforeseen, then you probably want to exit that contract, and the home inspection is a way to do that. Appraisal, separate process. That is something that I order as a lender. And the appraiser, however, does not work for me. The appraisers are independent, and their job is to represent the collateral, the house, in a independent, objective fashion, and to give a lender the what the value of that house is. So all three of these can be contingencies that are in your contract that will give you a way out should a way out be needed. And that leads to counteroffers. And a lot of times people don't like to negotiate. Again, this is sort of where I would say having a real estate agent, a professional real estate agent, is a really good thing because They're not emotionally tied to the house or the process or the fact that our lease is coming up and we have to get out. They're going to represent you, and they are going to be the one that negotiates. So when that home inspection comes back and it's got issues, then they're going to go head to head with the other real estate agent, and they're going to go ahead and try to negotiate the best possible deal for you, whether it if there are things that need to be negotiated, like a lower price or credit at closing. A seller can pay for some, or in some cases all, of your closing costs should that be negotiated in the contract. And a home inspection is often where we'll see repairs that might be needed, but instead of making the repairs, and if they're cosmetic in nature, it wouldn't be a big deal for the lender. They'll just say, hey, we'll give you $1,000 for closing cost credit. And that's a great thing, because closing costs definitely are money out of your pocket. So we talked a little bit about a home inspection, and I'm not going to go into great detail here except to say that every single system that's in a house, a home inspector will go through. So they're going to go through every single bit of that thing. So let's talk about the mortgage. So, if you get a fixed rate mortgage, I'm not certain that there's a reason to get an adjustable rate mortgage at the moment. Typically, you buy a lower rate with an adjustable rate mortgage, but you're accepting some of the risk, because at some point, that mortgage is going to adjust. It could be 5 years, it could be 7 years, 10 years, 15 years even. But there is going to be an adjustment. And the length of time between your fixed period and the adjustment period is going to determine how low that rate's going to be. So if it's only going to be a year or 3 years before the rate adjusts, then you're probably going to get a pretty good deal. But I got to say, right now, with fixed mortgage rates as low as they are, there's really no reason to grab an adjustable rate mortgage, even if you're not sure if you're going to be in that property for the rest of your life. You get a 30-year mortgage, you're not really going to pay it for 30 years. The reality is most mortgages last 7 to 10 years. They are either refinanced or the property sells. And so, what you're looking at is the lowest possible mortgage payment, but also peace of mind. The reason why sometimes an adjustable is not that great a choice, even if you're only going to be in that mortgage for 7 to 10 years, and again, that's just statistically, it can be a lot longer, is because there's some uncertainty there. And you don't know, it could be longer, and sometimes the rate differential just isn't enough to make it worthwhile. And that's really the case right now, in my opinion. So fixed rate mortgages, that does represent the greatest majority of the mortgages that are out there. And there's a bunch of different kinds. So conventional is probably one of the most popular, and a conventional loan just means it's probably a loan that's going to be sold to Fannie Mae or Freddie Mac. They are the backer of mortgages. They replace the money so that lenders can go out and lend money again. And that is really a good chunk of mortgages. Jumbo is a smaller chunk. So that is everything that's above the limit that Fannie Mae and Freddie Mac say that they are willing to go to. So they set a limit every year based on census data and home sales. And they say, that's it, that's the highest loan that we'll buy. Everything above that, by and large, is going to be a jumbo loan. And that's a very different market. VA loans are great if you're a veteran. You can put as little as $0 down. They're a very good loan with very good rates. FHA is also a very good option. This is another government-backed loan. And the advantage with FHA typically is that it will allow a more modest credit score without a hit to the rate. A conventional loan is going to be very tied to your credit score. An FHA loan is going to be tied to your credit score to an extent, but by and large, it's more of a one-size-fits-all. And the government is providing the guarantee. So they're the guarantor of this loan, and they are saying that, as long as you put in a certain percentage, they're going to guarantee the loan, and you're going to pay, however, that insurance, the government guarantee for the life of the loan in most cases, not all, but most. Again, we're going to go through the broad strokes here. And if you would like specifics about programs or are ready to pre-qualify, then you can reach out to us and we'll certainly take care of you. The last one down there is USDA. And USDA is indeed the same people who inspect your fruit, vegetables, and meat. They've got a mortgage program too, and why not? They are encouraging rural housing, and in Charlottesville, we're pretty fortunate because most of our area qualifies for this program. So in order to utilize it, you have to be in a rural area. And for us, anything south of 64 and east of 20, everything north of around Carisbrook, that area, and sort of east of Ivy or west of Ivy, east of 20. Yeah, those are all going to qualify. So everything in the middle, though, is not going to qualify because that's going to be considered too densely populated. So by and large, there's quite a bit of area there that would qualify for USDA, and they'll guarantee the loan as well, and they will allow you to have a zero down payment. So pretty darn good program. Now, with the government programs, there are a few more hoops to jump through. Obviously, with VA, you have to be a veteran. With a FHA loan and a USDA loan, the appraisals are a little more stringent. There's a few more requirements in there. But they're good programs, all of them, and of course conventional loans are very good. The one big caveat I have with conventional versus government, typically on the government loans, the mortgage insurance or the guarantee that you're paying lasts for the life of the loan, whereas with a conventional loan, the private mortgage insurance will drop off after a period of time. So there's a time period where you're paying it. Once your loan balance gets to a certain place, it'll drop off. So there are some methodologies to get rid of the private mortgage insurance without having to refinance or do anything. As far as the mortgage application process, so you can go to our website and you can complete an application, or any other lender for that matter. Most have the ability to do an online application, which to me is probably the easiest and best way to apply. When you submit an application, there's going to be quite a bit of documentation that is required, and it may not be required right at submission. It may be required after a loan officer has had a chance to look at your application, but it's typically going to include income documentation like pay stubs, W-2s, and taxes. Usually, if you have a down payment, you have to prove those assets, so that money needs to be in your bank account. And this is probably a good place to bring up assets, which is if you're going to put money down on a house, that money needs to be seasoned. So if you're a cash saver and you have a lot of cash, we can't count cash. It doesn't exist for us. So you can't just dump that in a bank, because we have to then, if there are any large deposits in our statements that we're looking at, we typically will ask for 2 months of statements. And if there's a large deposit, like anything over 50% of your monthly income, then we have to show where it came from. And if it came from just cash accumulation, we can't count it. So it's a good idea, if you are a cash saver, to go ahead and get that money in the bank ahead of time so that you can utilize it for a down payment. So asset documentation, income documentation, we're going to pull credit, and we want to know where you've lived for the last couple of years. So there's all of that to sort of put together. And it's a good idea, if you're going to be applying for a mortgage, to make sure that you do have all your documentation. If you're in transit and you have a lot of stuff in storage, it's going to be worth some time to pull all of that together, try to put it into one file box or someplace so that you'll have it ready when you're doing a mortgage. Being prepared is going to make this a much smoother process. Settlement agent, title search, appraisal, most of that is going to be handled by your lender. The settlement agent is something that you get to select. Most people do not know who a settlement agent is. That is actually a really important role, and it's a good idea to just talk to your lender or your real estate agent about who to use for settlement. Attorneys in the city of Charlottesville and in our area are very popular choices. They can give you legal advice. There are also title companies that can do settlement, and they are typically a little more affordable, but they cannot give you legal advice. And the whole process for a settlement agent, they actually conduct the title search, and they are the place you go at the end and bring your money. So that's going to be important to know who you're using, and they do charge a fee for their service. So shopping around a little bit can be a good idea. In my experience, they're all pretty similar though. And I tend to suggest that you talk to your real estate agent or your lender and get their advice, because they're working with settlement agents literally every day, and so they know who gets the job done. And I will say in our area, pretty much all of them do. I really don't have any complaints about any of them. They all do a really good job. But that is going to be an important point in having that in mind. So as you're walking through this process, you have the mortgage application, then you've made a purchase, it's been accepted. You're going to have your loan underwritten. That's kind of in between the two blue circles there. It's an important piece. But once that loan is underwritten and it's approved, you're going to have a commitment letter. And that commitment letter is going to say, okay, based on everything that we've reviewed, we're going to lend you this money. There may be a couple of conditions attached to that we need to satisfy, but you're good to go. And then you're going to go to closing, and at closing, you're going to sign all your documents, and all the money is going to be dispersed by that settlement agent. So again, another important point is where do you bring your money and how do you bring your money? In this day and age, it's going to need to be a wire. So if you bank at an institution that you need to prepare a wire in advance, or you have to do it in person, you just want to prepare that in advance, because when you go to settlement, all that money has to be with the settlement agent on the day of closing. And the last step when the house becomes yours is when the settlement agent goes to the courthouse and they record the deed. At that point, they give you the keys. Just a little bit more about the mortgage process. So credit score impact, it's a big one. The minimum credit score of 620 will get you in the door, but the rates are not going to be super attractive. And you may find that, while a 3% down payment is very possible, even with a 620 credit score, the underwriting may be a little more challenging, because typically you have a 620 credit score, there's a reason for it, and an underwriter is going to want to know what the reasons are. And usually with any kind of credit event, what they're looking for is that a one-time event, and is it going to repeat, or was that kind of one and done? Was there something that happened that caused a dip in credit, but otherwise you've done a great job? So those will be important points. Now with the government programs, with COVID, the requirements for a lot of these programs actually went up quite a bit. So I would say in March or April, the requirements were a 680 or above for almost any kind of loan. And now they have actually relaxed quite a bit and got back to more normal standards. For us, a 640 for VA, FHA, USDA, those are required. We would need a 640 credit score or higher. There are some investors and some lenders who will go lower than that, though. And if they can go lower than that, sometimes that's not a bad deal. Now, again, you can expect to pay a higher rate for a lower credit score. When we look at credit, we look at it sort of in buckets of 20 points at a time. And if you remember, I said you get 3 credit scores. Of those 3 credit scores, we throw out the top and the bottom score, and we use the middle score. And if there's more than one borrower, we use the lower of the middle scores. So unlike like an auto loan where you can get a cosigner and you get the benefit of a higher credit score, with a mortgage, it's the opposite. We take the person with the lowest credit score, and that's the one that sets the rate. So an important point. The debt ratio is really the other key thing that we're looking at. So what that means is we're going to look at your gross monthly income. Now, depending on how you're paid, that calculation can vary quite a bit. Typically, we don't like to use overtime and shift differentials and anything that can change or can be taken away by your employer. That doesn't mean we can't use it. It just means that ideally, we would like to use your base monthly income. So if you are, and again, if you're someone who's paid hourly, we would want to take the hourly, but we have to verify how many hours are consistent for you. It might not be 40 hours a week. It might be 37, or it could be 32. Full-time employment it does vary these days as far as what an employer considers full-time. So again, that calculation it can vary quite a bit. And when you look at your income versus when I look at your income, we may see 2 really different numbers. So again, we're using gross, not net, and that's what these percentages are based on. And what I can count may be different. And again, or I shouldn't say again, but one of the other caveats to that is any income I use, I have to have a reasonable expectation that you're going to receive it for the next 3 years. So that rules out a lot of different types of income. And it rules out things that have any kind of a hard date where it's going to stop. So again, just important points when you're looking at how much you can qualify for. And generally speaking, a conventional loan, you can go to 45 to 50%. An FHA loan can go higher than that in a lot of cases. A VA loan can go higher in a lot of cases. And USDA is actually more restrictive. So again, because you have a smaller, in this case, a 0 down payment, the ratios are a little bit lower. There's a little give in those 29-41, and that first ratio on the USDA is the housing payment. So they want to make sure your housing payment does not exceed 29% of your gross monthly income, and that your total debt does not exceed 41%. And I guess I should have pointed out that the debt ratio we're calculating is all your monthly debt. So that is going to be the minimum monthly payments that come through on the credit report, plus the new mortgage payment. So we're going to add all that together, and we need to keep your debt ratio below these ranges. And again, even if I qualified you at 45 or 50% of your gross monthly income, that could be a house payment that's quite a bit higher than you're comfortable paying. So you have to season that with how much are you willing to pay. Homeowners insurance, we talked about the fact that that is, number one, an important piece that should not be overlooked. It tends to get pushed away to the end, and I usually encourage people to start in the beginning because, number one, with all the refinancing going on, there are insurance agents, like everyone else, are busier than they usually are, and so their ability to write that policy and get everything together. Sometimes they have to go out and inspect the property personally. That all takes time. So it's a good idea to start ahead of time. If you're not sure who to use for homeowners insurance, the best place to start is typically anyone you use for auto insurance, or to talk to your lender or real estate agent, because they typically have people that they've worked with in the past that offer good rates, good deals, and shopping around at this point is probably going to be a good idea. As far as the cost goes, all of these factors that you see on the screen are going to be a piece of that. Probably one of the biggest ones going to be things like deductible and what you want to cover in your homeowners insurance. But all that needs to be considered when you're getting the policy and when we're calculating how much your mortgage is. Again, if you're at the edge of qualification and the homeowners insurance costs significantly more than what we estimated, then that could be a problem for qualification. So again, these are all conversations to have as you're getting qualified. And with that very quick and big overview, I do want to point out that the credit union is a great resource for information. So, and in addition to the mortgage information that I'm providing today, we do provide all kinds of financial services. So you can go to our website. The Mortgage Web Center does have you can check our rates. There's mortgage calculators there. Certainly if you're looking to apply, you can apply there. But we have a lot of resources. And I do want to point out, in addition to the mortgage resources, just the general financial resources that are available and the financial webinars are really good. You might be in a place where you just need to get organized with your finances, and we have seminars for that. Or maybe you just want to, build your credit. We have seminars that will discuss that as well. If you do decide to utilize us, we have some great loan officers here in town, and this is their contact information, which we can provide later. We're here for you, and we do, all of our services free of cost. All of our financial, whether you're a member or not, all of our services are free for those in the community, and please feel free to utilize us. And with that, I believe we are done, and I'm happy to have questions.
We have two questions. I'm not sure if you can see the question and answer box. I'll go ahead and read those out. We have one question. What does a good mix of credit look like?
So typically you want to have some installment and some revolving debt, those two together. And sometimes you don't have a lot of choice on that. So if you are, if you happen to be in the market for a car, having an auto loan would be, an installment debt that is usually a pretty good one for building credit. Now, almost any credit, once you first establish it, you're going to see a dip in your credit score, not an increase in your credit score. But that usually reverses itself after you've started to make consistent monthly payments. I think most people say that when they do an auto loan, it usually takes about 6 payments before they start to see a spike in their credit score. With revolving debt, it's a little bit different, but that mix, as far as number of trade lines, I don't know that I can give you an exact number, but having some installment and having some revolving, maybe 1 or 2 credit cards, something like that. You can have more. I've heard some crazy people talking about getting 14 or 15 credit cards. I don't know that helps you at all. I'm not positive it would. Again, I think that having the longevity of credit is probably the most important thing. So establishing a relationship with the company where you're going to have credit for a while really does make a lot of sense.
Okay, one more. Let's see. If you would ideally like to buy clothes during a certain month, how many months in advance would you recommend submitting a mortgage application?
That's a really good question. So first off, I would say if you are even considering a house a year from now, it's not a bad idea to get pre-qualified. So pre-qualified means you will have a hit on your credit, but it's to establish what price point you can be in, and to identify any problems that might exist. And that would give you time to correct problems. But and I will say in Charlottesville, that question is really relevant because most people are sort of working around the UVA life cycle. And so they've got kids that need to start school and, kind of want to be in their house through the summer. Most purchase closings are going to take 30 to 45 days from the day that contract is fully ratified. So remember, you're going to sign a contract, you're making an offer. It goes to a seller. They look at it, they send you back a counter offer that goes on for a couple of days. And so, once that is signed by everybody, that's go time. So at that point, you're looking at a minimum of 30. And speaking from a selfish lender perspective, I would like to have 40 or 45 days because everything right now, at least, is taking a little longer. Appraisals take longer, title searches take longer, underwriting's taking longer. So, all of that together means there needs to be sufficient time. That being said, we just closed a loan in 18 days, I think. So if you're targeting a specific month, I would say, and again, it depends on what point you're starting from, but I would like to see it 60 days ahead of time to give some time. But again, you really have to gauge it from when you have a signed and ratified contract. And that's kind of hard to put a fine point on unless you already have a house in mind and are prepared to sign a contract.
Great, thank you. So for those of you still there, just give one more second. Any other questions? All right, if not, then big thank you to Matt and to the University of Virginia Community Credit Union for their support. And for those of you who are UVA employees, don't forget open enrollment will continue this week and next week, and make your changes. Okay, thank you, Matt. Have a great day.
Thank you. Appreciate you having me. Take care.